Hi, this is Keith Kale here, and I wanted to do a quick financial knowledge drop for everyone. I like doing these little short videos talking about different financial concepts, and I hope you find this useful. One of the questions I get is, does contributing pre-tax dollars to my retirement plan reduce my current taxes and therefore improve my current cash flow? So it's an interesting question, and I thought we should investigate a couple different ways to look at it to see how it works out. So what I've done is created two situations. Let's look at situation A. In this scenario here, we have someone who has $10,000 of taxable income, and they're going to go ahead and earn that money and pay tax. And let's assume they're in a 30% marginal tax bracket, just for the purpose of this argument. They're going to owe $3,000 in taxes on that, leaving $7,000 available to be invested. And let's assume during this investment they're able to get a 10% time value of money rate on that, which would be $700. And so when we add those together, they get $7,700 of cash flow from this process. And let's compare or contrast that to another situation. So this other situation, plan B over here, we have the same $10,000, but they're going to invest that money pre-tax. So all of that money will go into the investment and potentially earn, let's say, that 10% time value money rate, same as the other side. That would be $11,000. And so again, we're measuring current cash flow. So if they cash this in and pay the tax on that, they're going to owe $3,300 in taxes. And if we take that away from $11,000, they're going to end up with $7,700. And so really, these two numbers are the same. And this informs us that really contributing pre-tax dollars to a retirement plan does not improve current cash flow. As a matter of fact, retirement plans are somewhat illiquid. As you all know, if you do cash that in before you're 59 and a half, you're going to pay a 10% penalty. And so you're going to owe another penalty on that. 10% of that would be another $1,100. And so really you'd end up with $6,600 if you're not the right age when you tap into the money. And so I hope this helps you understand. And this is why when I talk to people about their 401ks, a 401k, buying investments inside of a retirement plan is not necessarily a tax savings event. It could be, and the only way to guarantee that would be to make sure that your income is lower in retirement than it was before you retired. If you're in a lower tax bracket in retirement, then you might possibly pay less in tax. But that's not a given. And as a matter of fact, when you're starting out with your investments, like your 401k or IRA, unfortunately, you don't get to check a box to lock in that future tax rate. That will be set by Congress at some point in the future. So if you're retiring 10, 20, 30 years from now, we have no idea what those tax brackets will look like in the future. And it's possible that you could have what I would call reverse tax planning. So it's possible when you retire, you could actually owe more tax on that money on the back end than you would have had you paid the tax as you go on the front end, especially if you're younger with a lower income building up in those younger years. You might be better off with something in a tax-free category, like a Roth IRA, for example. So with this in mind, you may not want to overfund those 401ks too much. I like to see some tax diversity, and so definitely take advantage of what your company is matching you. But the old conventional wisdom to, quote, max out your 401k, unquote, might not be good advice given these taxable situations and the need for potential liquidity. So I hope that helps, and if you'd like to know more, you can certainly check me out on my website. It's called www.myfinancialexcellence.com. I have a lot more knowledge pieces there for you, some resources and downloads, and you can also look into one-on-one coaching to help you make better decisions with your money. All right, have a great day, and we'll talk to you soon.